What if you could invest like Warren Buffett, even with just $1,000? Today, I'll show you 3 companies Buffett has poured billions into, and why they're perfect for everyday investors. These aren't random picks. Each is a strategic, long-term play that fits Buffett's value investing philosophy. We'll cover a leader in energy, a pioneer in satellite radio, and a global fast food giant. These companies have strong brands, wide moats, and are accessible to all investors. I'll break down why each made it into Berkshire Hathaway's portfolio, and how you can start building your own Buffett-inspired portfolio. Get ready, these insights could change how you invest forever. Hit like, share your thoughts in the comments, and subscribe for more investing updates. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. First up is Occidental Petroleum, ticker OXY, a company that's become a cornerstone of Warren Buffett's Berkshire Hathaway portfolio. Today, Berkshire owns over 28% of OXY, making it one of the most significant energy bets in Buffett's storied investment career. This isn't just a passive holding. Buffett has been steadily increasing his stake, signaling deep conviction in the company's future. Occidental is a dominant force in the Permian Basin, which is not only the most productive oil field in the United States, but also one of the most prolific in the world. This region is the heart of American oil production, and OXY's extensive operations here give it a significant cost advantage over competitors. The company's scale and efficiency in the Permian create a durable competitive edge, allowing it to produce oil at lower costs and higher margins, even when prices fluctuate. One of the main reasons Buffett is so enthusiastic about OXY is its ability to generate massive cash flow. This robust cash generation isn't just a number on a balance sheet, it's the engine that powers the company's ability to pay down debt, buy back shares, and reward shareholders with consistent growing dividends. In an industry often plagued by boom and bust cycles, OXY's financial discipline stands out. The company's focus on returning capital to shareholders aligns perfectly with Buffett's own investment philosophy. At the helm is CEO 𝗣𝗟𝗗𝗏, whose disciplined approach to capital management has earned her respect across the industry. 𝗗𝗏's leadership is marked by a relentless focus on efficiency, prudent investment, and long-term value creation. She's not just running an oil company, she's steering OXY through a rapidly changing energy landscape, making tough decisions that position the company for resilience and growth. Her philosophy of disciplined spending and strategic investment is a perfect match for Buffett's own approach to business. A pivotal moment for OXY came with its acquisition of Anadarko Petroleum. This bold move transformed Occidental into a much larger and more diversified energy company. But it also brought significant debt, which could have been a risk. Instead, OXY doubled down on strengthening its balance sheet, aggressively paying down debt and streamlining operations. This focus on financial health has made the company more resilient to the inevitable ups and downs of the energy markets, and it's a key reason why Buffett has continued to increase his stake. The world is clearly moving toward renewable energy, but the transition will take decades. In the meantime, oil and gas remain absolutely essential to the global economy. Buffett's investment in OXY is a bet on this long-term reality. He understands that while renewables are growing, the world will still need reliable, affordable energy from oil and gas for many years to come. OXY's assets and expertise position it to thrive during this transition, providing the energy the world needs while adapting to new technologies. But OXY isn't just resting on its traditional oil business. The company is investing heavily in carbon capture technology, aiming to become a leader in the emerging field of carbon management. By capturing and storing carbon dioxide emissions, OXY is not only reducing its environmental footprint, but also creating entirely new revenue streams. This forward-thinking approach could give OXY a major advantage as governments and industries around the world look for ways to meet ambitious climate goals. For Buffett, OXY checks every box. It's an industry leader with world-class assets, generates strong and reliable cash flow, is run by smart and disciplined management, and is investing in the future of energy. This combination of strengths is rare in the energy sector, and it's why OXY stands out as a top holding in the Berkshire Hathaway portfolio. Investing in OXY is also a bet on American energy independence. The company's operations are deeply rooted in the United States, supporting thousands of jobs and contributing to the nation's energy security. OXY's commitment to operational excellence and innovation ensures it remains at the forefront of the industry, even as the energy landscape evolves. Of course, no investment is without risks. The biggest challenge for OXY, and for any oil company, is the volatility of oil prices. Global events, supply disruptions, and shifting demand can all cause prices to swing wildly. But Buffett's willingness to invest so heavily in Oxy signals his belief that the company can weather these storms and deliver long-term value, even in a turbulent market. Oxy's approach to rewarding shareholders is clear and disciplined. The company has laid out transparent plans for dividends and share buybacks, but only after it meets its debt reduction targets. This ensures that shareholder returns are built on a solid financial foundation, not just short-term gains. It's a strategy that prioritizes long-term stability and growth, which is exactly what Buffett looks for in an investment. Even after a strong run in its share price, Oxy still trades at a reasonable valuation compared to its peers. When you factor in its cash flow potential, world-class assets, and strategic investments in new technologies, the stock looks attractive for long-term investors. It's not just about today's profits, it's about building value for years, even decades to come. The company's vast assets in the Permian Basin provide a durable economic moat, protecting it from competitors and ensuring steady production. Meanwhile, Oxy's investments in carbon capture and other advanced technologies could become major growth drivers in the future, opening up new markets and revenue streams as the world transitions to cleaner energy. Ultimately, Buffett's investment in Oxy is a bet on American ingenuity, resilience, and the enduring need for energy. It's about backing a company that's not only adapting to change, but also helping to shape the future of the industry. For retail investors, owning Oxy is like getting a front-row seat to a masterclass in capital allocation and strategic management. You're investing alongside one of the greatest investors of all time, in a company that's executing a clear, disciplined plan for growth and shareholder returns. While it's true that Buffett secured a special deal on his initial investment, his growing position in Oxy's common stock shows that he believes in the business for all shareholders, not just himself. His actions speak louder than words, and his continued buying is a powerful vote of confidence in Oxy's future. Occidental Petroleum boasts a market cap of $42.01 billion, with earnings per share sitting at $2.63 and a P/E ratio of 16.97. The company generated $26.73 billion in revenue in 2024, translating to a solid net income of $3.06 billion. Yet despite these strong fundamentals, the current stock price of $44.63 is trading at a significant 75.35% discount to its fair value estimate of $78.26, suggesting substantial potential upside for value-oriented investors. In summary, Occidental Petroleum is a top-tier energy company with world-class assets, disciplined and visionary management, and a clear, forward-looking strategy for long-term value creation. It's a rare combination that makes Oxy a standout in the energy sector. With Warren Buffett as your co-investor, Oxy offers a compelling opportunity to build wealth, benefit from American energy leadership, and participate in the future of global energy. Next up is Sirius XM Holdings, ticker symbol SIRI, a company that has become synonymous with satellite radio and stands as a textbook example of a Buffett-style investment. Sirius XM is not just a household name, it's a dominant force in the audio entertainment industry, with a business model that has proven resilient and adaptable over the years. Sirius XM holds a near monopoly on satellite radio across North America. Its satellites beam exclusive content to millions of vehicles, and its technology is seamlessly integrated into the dashboards of most new cars sold today. This gives Sirius XM a massive installed base and a unique distribution advantage that's hard for competitors to replicate. The company's subscription-based business model is incredibly sticky. Once customers get used to having ad-free music, talk shows, and live sports at their fingertips, they're unlikely to switch. This stickiness translates into highly predictable recurring revenue streams, something every long-term investor loves to see. One of the hallmarks of a Buffett investment is pricing power, and Sirius XM has it in spades. Thanks to its exclusive content and lack of direct competition in the satellite space, the company can gradually raise subscription fees without losing many customers. This ability to nudge prices higher over time is a key driver of its robust cash flow. While streaming giants like Spotify and Apple Music are fierce competitors in the broader audio market, Sirius XM offers something different. Its curated channels, live personalities, and exclusive shows create a unique, everywhere accessible experience that especially appeals to drivers and commuters. For many, Sirius XM is a daily habit, not just another app. Recognizing the need to evolve, Sirius XM has expanded its reach beyond satellite radio. The acquisition of Pandora brought millions of streaming users into the fold, and the Sirius XM app now offers on-demand content, podcasts, and personalized playlists. This transformation positions the company as a complete audio entertainment platform, not just a radio provider. Berkshire Hathaway's stake in Sirius XM is held through Liberty Media, which is run by John Malone, a legendary capital allocator and a longtime favorite of Warren Buffett. Mallone's involvement adds another layer of confidence for investors, as he's known for his savvy deal-making and focus on shareholder value. SiriusXM is a true cash flow machine. The company consistently generates more cash than it needs to operate, allowing it to return significant value to shareholders. This comes in the form of regular dividends and aggressive share buybacks, which boost earnings per share and reward long-term investors. Despite its strengths, the stock has faced pressure from fears about competition and changing consumer habits. However, its strong economic moat, reliable cash flows, and entrenched position in the auto industry make it a compelling value play for those willing to look past short-term noise. Every year, millions of new cars roll off the lot with SiriusXM radios pre-installed. This built-in presence ensures a steady pipeline of potential subscribers, as new car buyers are often given free trial periods that convert into paid subscriptions at impressive rates. Exclusive content is a major draw. SiriusXM's deals with personalities like Howard Stern, live sports broadcasts, and special events create a powerful moat. These offerings are difficult for competitors to match and foster deep loyalty among subscribers who can't get this content anywhere else. The company's foray into podcasting and digital advertising is another sign of its adaptability. By diversifying its revenue streams, SiriusXM is positioning itself to capture growth in the fast-evolving world of audio entertainment, ensuring it remains relevant as listener habits change. SIRI often trades at a discount to its intrinsic value, giving patient investors the opportunity to buy a high-quality, cash-generating business at a fair, or even bargain, price. For value investors, this is the kind of setup that can lead to outsized returns over time. Customer loyalty is another key advantage. SiriusXM enjoys low churn rates, as subscribers tend to stick around year after year. The habit of listening during commutes or road trips becomes ingrained, making it difficult for competitors to lure customers away. The investment thesis is clear. SiriusXM boasts a near monopoly in its niche, a sticky and growing customer base, strong and consistent cash flows, and a management team focused on returning capital to shareholders. These are the hallmarks of a classic Buffett-style holding. Over the years, SiriusXM has weathered multiple waves of technological disruption, from the rise of MP3 players to the explosion of streaming apps. Yet it has not only survived but thrived, adapting its offerings and maintaining its leadership in the audio space. With a market cap of $8.19 billion and annual revenue of $8.7 billion in 2024, the satellite radio giant posted a troubling net loss of $1.67 billion. Still, the stock trades at $24.17, 51.14% below its fair value target of $36.53. That wide gap may catch the eye of contrarian investors betting on a turnaround. For small investors, SIRI represents a rare opportunity to own a unique American media franchise. It's a business that rewards patience, with a focus on long-term value creation and a commitment to returning cash to shareholders. In the end, SiriusXM is a simple, profitable, and resilient business, one that fits perfectly in a Buffett-style portfolio and continues to deliver for those who believe in the power of durable competitive advantages. Our final pick is Domino's Pizza, ticker DPZ, a global powerhouse that's much more than a fast food chain. While most people know Domino's for its hot, cheesy pizzas delivered to your door, there's a lot more going on behind the scenes that makes this company a standout in the world of business and investing. Domino's is, at its core, a technology and logistics company. Its powerful brand is just the tip of the iceberg. The real magic lies in its simple, scalable business model that's been refined over decades. Domino's has mastered the art of getting food from kitchen to customer faster and more efficiently than almost anyone else in the industry. Its relentless focus on tech, like best-in-class online ordering and delivery innovation, creates a massive competitive advantage. Domino's was one of the first to roll out a pizza tracker, letting customers follow their order in real time. Their app is intuitive, fast, and constantly updated, making it easier than ever to order a pizza with just a few taps. Behind the scenes, Domino's invests heavily in its digital infrastructure, using data analytics and artificial intelligence to optimize delivery routes, predict demand, and even test new menu items. This tech-first mindset keeps Domino's ahead of the curve and ensures customers get their food quickly and accurately. Over 98% of stores are franchised, making Domino's a capital-light, high-margin business with incredible returns on invested capital. This franchise model allows Domino's to expand rapidly without taking on the risks and costs of owning every location. Franchisees are highly motivated, and the company supports them with robust training, marketing, and supply chain systems. The brand, tech infrastructure, and scale give Domino's a wide moat that's tough for competitors to match. With thousands of locations worldwide, Domino's can negotiate better deals with suppliers, invest more in technology, and deliver a consistent experience to customers everywhere. Domino's is a global growth machine, expanding rapidly in emerging markets through its franchise model. In countries where pizza delivery is still a novelty, Domino's is often the first mover, capturing market share and building brand loyalty from the ground up. The supply chain centers provide another high-margin revenue stream and ensure quality control. By controlling the flow of ingredients and supplies, Domino's can guarantee that every pizza meets its standards, no matter where it's made. This vertical integration also helps franchisees keep costs down and operations running smoothly. Buffett loves businesses with dominant market positions, high returns, and scalable models. Domino's checks every box. The company's ability to generate strong free cash flow and reinvest in growth is exactly what long-term investors look for. For investors, DPZ offers a piece of a blue-chip growth company with a proven track record. Over the past decade, Domino's stock has outperformed many tech giants, rewarding shareholders with impressive returns. Domino's business is resilient. Even during downturns, people crave affordable, convenient food. When times are tough, families still treat themselves to pizza night, and Domino's is often the first choice thanks to its value and reliability. The brand is woven into the fabric of everyday life, from game nights to celebrations. Domino's has become synonymous with quick, satisfying meals that bring people together no matter the occasion. The management team balances smart capital allocation with investment in tech and growth. They're not afraid to make bold moves, whether it's launching new menu items, investing in delivery innovation, or expanding into new markets. Domino's fortressing strategy, opening stores close together, reduces delivery times and boxes out competition. This approach means fresher pizza for customers and more efficient routes for drivers, boosting both customer satisfaction and profitability. The brand's turnaround story shows a culture of honesty, adaptability, and bold improvement. Domino's famously admitted its pizza needed work, then reinvented its recipes and marketing, winning back customers and setting a new industry standard. Investing in Domino's is a bet on convenience, technology, and a world-class franchise system. The company's commitment to innovation and customer service keeps it ahead of the curve, while its franchisees drive local success. Unlike delivery aggregators, Domino's controls its own delivery network, protecting margins and customer relationships. This direct-to-door approach means Domino's can guarantee quality and service, building loyalty that third-party apps can't match. International growth is just beginning, with huge potential in many markets. As Domino's adapts its menu and service to local tastes, it's poised to capture new customers and drive global expansion for years to come. Through a Buffett lens, Domino's is a company with a wide moat, high returns, and a long runway for growth. Its disciplined approach to capital allocation and focus on shareholder value make it a textbook example of a compounding machine. With a market cap of $16.54 billion and a hefty EPS of $17.33, Domino's maintains a P/E ratio of 27.49. In 2024, the company generated $4.71 billion in revenue and posted a net income of $584.17 million. The current share price sits at $476.34, which is 18.34% below the estimated fair value of $563.70, making it a potential opportunity for investors looking for growth with a bit of a discount. For retail investors, DPZ is a chance to own a piece of a best-in-class operator with global reach. Whether you're looking for growth, stability, or a company that thrives in good times and bad, Domino's delivers. It's not just about pizza, it's about a finely tuned system built for efficiency and profitability. Every step from dough to doorstep is optimized for speed, quality, and customer satisfaction. Domino's is a slice of excellence and a classic Buffett-style investment. With its winning combination of technology, brand power, and global ambition, Domino's is set to keep delivering value for years to come. There you have it, 3 Buffett-style stocks: Occidental Petroleum, Sirius XM, and Domino's Pizza. Each has a powerful moat, strong business model, and long-term potential. By understanding Buffett's approach, you can apply the same principles to your own portfolio, even with just $1,000. Want to learn more? Check out my Value Stocks Investing Master Course. Link in the description. For exclusive tips and analysis, join the Stocks Galore Patreon community. Which of these Buffett stocks excites you most? Let me know in the comments. Like, subscribe, and stay tuned for more investing insights.